Good morning, everybody. This is the live market open for January 7th. It's Thursday. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Today we'll have a normal show. After yesterday, we had a 2016 outlook. We'll talk about, of course, recent developments, and we had very turbulent markets, charts and levels, a lot about crosses probably today, and the next 24 hours. And you're welcome to ask your questions during the show, at the end of the show, and also about yesterday's outlook at the chat below. If you can't see the chat, please go to the address here on the screen, tlk.io/fxstreet-forex-live-video. So before we talk about recent numbers, let's talk a bit about markets, okay? So we had very, very turbulent markets in the world. We had stock market crashes all over the world. We had oil prices slipping once again. There's a gloomy atmosphere. Okay, about oil prices, we had oil prices fall because of, the usual factors: too much supply, not enough demand. The too much supply came yesterday from the oil inventories. They were actually, the crude oil inventories fell, which is supposed to be good for oil, but the distillates, the amount of refined oil, was actually on the rise. So this also reminded us that supply is too high. Not news, but just a reminder. And demand, all the things going on in China, the fall of the Chinese stock market, the devaluation of the yuan, which shows that China is in trouble. All this also weighs on markets, okay? We had that yesterday with oil. We had it, everything got worse during the night with the Asian session. What we had during the night, we had Chinese stock markets open. Then we had the circuit breakers. They fell, the stock market fell under 5%. So trade was paused for a few minutes. But then when it resumed, it fell under 7%. And then the market just closed for the day. So Chinese stock markets today were open only 14 minutes and 17 seconds. Of course, this contributes to a bad atmosphere in markets. So let's talk about that and talk about the charts before we talk about different levels, different events. So what does this cause in market? Let's start with oil today. This is the price of WTI crude oil. It's at the lowest levels since 2004, okay? It broke under the 3270 line, which was the low in January 2009, the post-crisis low. And it fell, what's the recent low? Anyway, it fell still at the 32 handle, but 3208, okay? Last seen in 2004. So WTI crude oil joined Brent oil that also trades at these levels, okay? What does this cause in currency markets? It causes this risk-off atmosphere. Risk-off is good for the euro, good for the yen, mostly good for the yen, and the pound is sort of mixed in the middle, but not doing so well, and commodity currencies, especially the Canadian dollar, are crashing. So let's start from the top. Euro dollar. Euro dollar advanced yesterday. It bounced off these lows at 107.10 more or less and began moving higher, and then it even extended its rise up to 108.30. Now at the beginning of the European session, it's beginning to retrace a bit, but in general it's still higher than yesterday. The euro also has a dilemma. On one hand, ECB is expected to do a bit more because inflation in the eurozone is low. On the other hand, it's a safe haven currency. Well, also because of the ECB, because of the printing of money, so it's gaining some strength. Okay, there are less doubts about the yen. Yen is a safe haven currency. It fell and extended its falls. Now also it's stabilizing it just above 108, but it already fell to 117.66, and in general the trend remains down. Yen traditionally has low interest rates. It's a funding currency for taking risks abroad, and in times of trouble, money is repatriated back home. This is, of course, not what the Bank of Japan wants to see. It doesn't want to see a stronger yen, and it doesn't want to see a weaker yuan. It doesn't want to see its rivals in China becoming more competitive. Okay, now let's talk about the pound. This morning another breakdown, another new low for the for cable under 146, currently 145.89, very close to the lows It sort of held above 146 yesterday. Yesterday's services PMI was actually okay, but but with this sell-off in markets, the pound is not one of the strongest. UK Chancellor George Osborne said that the British economy is facing a cocktail of threats, whatever that means, but in general, Chinese slowdown, geopolitical tensions in various places in the world. Of course, pushing the blame elsewhere. It's nothing to do with this government's policy. Well, that has some truth to that, but also I think critics should look into the government's policy. As we speak, we're digging new lows in pound dollar. Dollar yen we talked about. Dollar CAD, well, I think I said this many times in recent weeks. The sky's the limit. New highs at 141.35. Yesterday we had the pair sort of making an attempt to break higher. To move a bit lower because Canadian trade balance came out better than expected. So not always bad in Canada, okay? But with oil prices dominating the scene, it's just new highs every day for dollar CAD. It's 141.29, 141.35 has been the peak. I would say that there's some resistance at 142 because I looked beforehand at this monthly chart, and we had back in August of 2003. Yes, 12 and a half years ago, we had dollar CAD sort of stopping at this level, but basically it's such an ancient level that, well, the sky's the limit. It depends more on the price of oil. Okay, Aussie dollar continued its fall. It struggled a bit, had a battle with this 70.65 line I mentioned. Doesn't work as a clear separator, but more as a battle line. But it seems that the battle has been won by the bears. New low 70.24. It's a bit stabilizing now. So we're seeing a small bounce this morning from the all risk off atmosphere that we had earlier, very early in the morning and during the night. 70.55 is the current level. And let's see, of course, support at the round number of 70. 70.65 is weak resistance, followed by 71.50, which is stronger resistance. Of course, China is the main issue. New Zealand, in comparison to other commodity currencies, this one stands out. It's still, the trend is clear to the downside. New Zealand dollar is a risk currency. Interest rates there are above zero at 2.5, which is the low. Currently at a very nice number of 666, almost 6, yeah. Number of the beast. Anyway, but we did have some small positive news from New Zealand tonight. We heard that Fonterra, the company that dominates the economy, that exports milk, they said that production is expected to fall. And of course, less milk means higher prices. That could be supportive of the Kiwi dollar, but it's relatively minor in comparison to the huge market forces we're seeing. Okay, dollar Swiss. Well, in theory, the Swiss franc is a risk currency, but as you can see, this is an inverse chart of euro dollar, but I would say between parity and 101.50 is the range. Euro Swiss, as usual, at the 108 handle, very stable in range. 107.60 seems to be the line that the Swiss National Bank defends. Euro pound, well, it had a big rise earlier, late in around Christmas, up to 74. Then it dropped back down. Now it's making a nice move back up. 74.10, I still see it as resistance, but it's a bit choppy around there. More interesting currency pairs, Euro Yen. Earlier this week, we had the Euro lose its safe haven appeal. It's still flirting with this. As I said, on one hand, the ECB pushes it down. On the other hand, the risk atmosphere pushes it up. So we did see Euro Yen stabilizing here. Let's draw a few lines. So we have 127 to the downside, and I would say 128 to the upside. Relatively limited range for this cross because both are safe haven currencies, but they're not twins. Okay, they're not identical twins. And here, with yen crosses, apart from the euro, and this one is one of the favorites, of course, for many traders, pound yen, this is a crash. This is a trend. Lows of around 172, not far from these lows at the moment. 175 turns into resistance. It was support in the past, I think back in, let's look, why. Yeah, 175 worked as support back in April and also beforehand. It's now broken very clearly. It now turns into resistance. What's the next level to watch? Of course, 170, because it's a round number. It also provided some weak support. I would say that stronger support is right here at 168. Yeah, 168 is further support on pound yen. Okay, so we have dramatic moves on pound yen. We also have, if you look at other yen crosses, I don't know which ones are of interest to you. Well, let's look at CAD yen, okay? Because this is the extreme between the risk on of the Canadian dollar and oil prices, which is not working apparently, and the risk off of Japanese yen. So we're seeing quite a big crash. This morning it's around 0.7%, but in the bigger scheme of things, look how far this pair has fallen. Maybe we'll look a bit, zoom in to recent days, see it trade around 86, 87, and then boom, currently under 84. This is one of the crosses, of course. Many yen crosses, Kiwi yen, a bit more moderate, but also a very clear trend. Aussie yen has also, Australian dollar fell a lot. Also here, similar levels to CAD yen because of the, because AUD CAD are almost at parity. And also a very clear range, after breaking this line here at 86.50. Boom, crash lower. Again, Australian dollar suffers from China. The yen gains from China. I mean, the trouble in China. Okay, so we talked about lots and lots of currency pairs. Let's look at some events we had yesterday. They were important events, but they were a bit overshadowed by, I prefer to start with recent market movements. Okay, so in the United Kingdom, services PMI, the most important one. For the UK, the most important one, because it's the biggest, most significant, was at 55.5. No real surprises. ADP non-farm payrolls came out better than expected in the United States. We expected under 200,000. It came out at a blockbuster 257,000. But the excitement, the thrill, then dissipated because some retail hiring towards the Christmas shopping season was blamed. So this was a bit skewed according to various analysts. So we had sort of an immediate strengthening of the US dollar, but it didn't go too far. US trade balance was also a bit better than expected. I assume non-manufacturing PMI missed by a bit, but the employment component was okay. Factory orders dropped as expected. Crude inventories, we talked about that, and the FOMC meeting minutes. Let me talk a bit about that. The Fed meeting minutes were from the decision made in December about raising the rates, the historic rate hike after nearly a decade. Now, we had so much information towards that event, so much information in that event. But the minutes is always all steer markets. Okay, what happened there? In the original statement, we had a focus on inflation. Yellen and her colleagues decided to put more emphasis on the path of inflation. Okay, that was the dovish thing. On the other hand, they talked about raising rates 4 times in 2016. And she showed confidence in the press conference about the economy in general, and also talked about rises in wages. Okay, and they want to be ahead of the curve. Remember, they don't want to be. She said specifically that they will not need to wait for inflation to reach 2% before acting, before raising rates once again. Yesterday, we had the Fed minutes, and we had a lot of focus on inflation there. We had this line standing out that there's significant concern about recent inflation. Okay, so even though future inflation is expected to rise, the current low levels of inflation are a serious concern. Some members are probably losing patience, okay? So that was the focus that hurt the US dollar. Yet again, that was yesterday at 7 GMT. Since then, we had more than 12 hours in the Chinese stock crash that sort of reshuffled all the cards once again. But in general, the meeting minutes were perceived as dovish. But that happens. But I don't think they were extremely dovish. We didn't hear Yellen. We didn't hear the Fed retreating from we don't need to wait for 2% to hike again. In addition, in many cases, we have the meeting minutes sort of taking the contrary direction towards the perception in comparison to the perception of the statement. Okay, remember, the meeting minutes is not just what everybody said in that meeting. It's not a raw protocol. It's actually a document that is revised and edited until the last moment. Okay, so there is, I mean, the Fed knows that this, naturally, that this document moves markets, so they make it as balanced as possible or to serve their interests. Okay, so the dollar fell, but just a bit. Now, that doesn't mean that the Fed is really going to raise rates 4 times and they're not extremely happy with the economy, but they are a bit, so we might have a change in policy, but the meeting minutes were not, for me at least, not a big surprise. And I think that after the initial moves, we had some kind of stabilization over there. Okay, let's talk about today's events. So we have the Eurozone unemployment rate at 10 GMT, an hour and a half from now, a bit more. That's expected to stand at 10.7. Let me just verify this on the chart, on the FX rate calendar here on Forex Crunch. Yeah, no, we don't have consensus here, but I've seen in other calendars it's about 10.7. Anyway, it doesn't change too much. Let's look at the trend. Sorry, we had already higher levels of unemployment in the Eurozone, above 11.5%. And in recent months, it's beginning to gradually fall a bit back down. And that's, of course, good news. Also good news for the ECB. The ECB can say its policy is working, or perhaps we're just at a turn of the cycle. Weaker euro also helping the European economies. I talked yesterday in the outlook for 2016, which is of course recorded and you can see it, that we might be getting closer to the bottom. It might become, we might be darkest before dawn. Lots of political trouble in Europe, and the ECB is hesitant and the inflation is low, but things might begin improving. Let's see if that unemployment rate provides us with a positive surprise and falls just a bit today. This might help the euro, but safe haven flows and worries about the ECB, of course, move the euro more than the unemployment rate. Question from Fabian. Just a second. Sorry, I'm back. It was a strong cough that I prevented you from hearing. Anyway, Fabian asks, how, as you said, the ECB printing more money relates to the euro being safe haven currency? Okay, important question. When the ECB prints money, that means this money is going, hopefully, to the real economy, steering growth. But some of it, because of the abundance of money, goes out of the Eurozone. The good thing is that the euro is weaker because the money goes out of the Eurozone, and this makes imports more expensive, which means higher inflation, and the ECB's goal is higher inflation. It also means that exports are more attractive because you can buy the same German car or Spanish wine for less money, and it competes with I don't know, an American, a Japanese car, or California wine. Okay, so that's the good effect for the Eurozone, but it's not a one-way street. When money is lent in euros and goes outside the Eurozone to get riskier assets, and also one of the things that causes it is the negative deposit rate. Okay, banks are punished for keeping money parked with the ECB. They're paying an interest rate to the ECB for keeping the money there. So another reason to push money outside the Eurozone. Okay, so money is lent very, very cheaply in euros and goes to find riskier assets abroad. What happens in times of trouble? this money is repatriated. So maybe the term safe haven is not the best one, because we've seen it also with the port of Piraeus, the haven of Piraeus in Greece. When things got worse in Greece, the euro actually strengthened in July. Okay, when we had an agreement in the Greece, an agreement about Greece, the euro actually weakened. So even if the trouble is at home, it doesn't really matter. If the money goes out of the eurozone looking for riskier assets in good times and is repatriated in bad times, because emerging markets, for example, are seen as riskier than the eurozone. This is a new phenomenon for euro dollar, for the euro in general, but a very, very old phenomenon for the yen. Okay, we've seen in the big earthquake 5 years ago, earthquake, tsunami, and nuclear disaster, how this Japanese yen strengthened, despite the fact that the country was hit quite hard by the tragedy, and the economy as well, of course. So that's what's going on also in the yen. Another follow-up question from Matthew: why the euro dollar not moving up under risk on conditions? Well, as I said, that's still a complicated case for the euro, and a risk on condition. When we had, for instance, yesterday, the Fed minutes, they were dovish. That means the Fed will not hike too much. That means more easy money. The euro did go up, okay? But it's not a one-way street. It's much, much clearer for the yen. It's not the same for the eurozone. For example, what we had this week, and it seems like long history from now with all this turbulence, but early in the week, on Monday, we had German inflation numbers coming out worse than expected. On Tuesday, the following day, it wasn't such a big surprise anymore, but also eurozone figures came out worse than expected. Inflation figures. This means that the ECB could act more, could print more money, push more money out of the eurozone. Okay, so this is a contrarian move that weighs on the euro, and but then we had more trouble in China, more trouble in oil, and we had the same sort of strengthening of the euro. So it's not so clear. In Japan, we have no risk at the moment of action from the Bank of Japan. This could change, of course, if the yen strengthens too much and the yuan weakens too much, the Chinese yuan. We could have the Bank of Japan act either by saying that the yen is overvalued or by acting, by printing more money. But at the moment, the Bank of Japan is relatively quiet. Okay, so that explains that. Let's go back to the events for today. We have the unemployment rate in the eurozone, also consumer confidence, which is also of importance, but I think the unemployment rate could overshadow it. What we have at 1:25 GMT is a speech from the Bank of Canada's Stephen Poloz. He could relate to the crash in oil prices, to the troubles in markets, and to future monetary policy. I'll remind you that, for those of you trading the loonie, that in January of last year, one day before the ECB's decision to announce QE, the Bank of Canada surprised markets by cutting the interest rates after a very, very long time of stable rates. It then cut rates once again later in the year. It recently said, the Bank of Canada said that the lower rate is is minus 0.5, whereas currently the interest rate is plus 0.5. Okay, so we have potential for interest rate cuts. In theory, they're not expected to cut it soon, but who knows, these surprises in the past. Oil prices are falling, and we might get a hint about that from Stephen Poloz. Tomorrow also we have job figures from Canada. They're not necessarily going to be bad, so and maybe Poloz knows that. So yeah, he could be also a bit more upbeat. Okay, at 1:30 GMT, we have the weekly jobless claims from the United States. Last week, just before New Year's, they were disappointing. Yeah, last week it jumped to 287,000. This time we're expecting a small drop, which is good news, of course, to 275 all in all. Yeah, this rise is the highest level since the summer, but it may be also seasonal, so I wouldn't be too worried unless it's a trend. Anyway, it's a very, very small hint towards the non-farm payrolls. Yesterday we got two positive hints. We got the ADP NFP, which came out better than expected, and we got the employment component of the ISM non-manufacturing PMI, which was also very stable on high ground at 58 points, if I'm not mistaken, which reflects still strong growth. However, as we had earlier in the week, the manufacturing PMI by ISM, and that was negative, under 50 points in the headline, under 50 points in the employment component. Okay, so this is less of a hint, but still of importance. And during the night, we have Australian retail sales. For those of you trading the Aussie, we had mixed figures from Australia tonight. We had, on one hand, trade balance came out a bit better than expected, 2.9, okay, but deficit a bit better than expected, but building permits, they disappointed with a drop of 8.4 year over year and 12.7 month over month. Okay, so it's a bit mixed, a bit confusing for the Aussie dollar. Okay, but let me say this. Today we have less important figures in comparison to yesterday, in comparison to tomorrow's non-farm payrolls. I'll have a full preview of that tomorrow, of course. But markets are very, very, very turbulent, very volatile. We should look for hints from stock markets and from oil prices. Okay, let's see how things develop in Europe regarding stocks, and more importantly, in the United States open at 2:30 GMT. And of course, follow the price of oil. And we have more questions here from Fabian. Despite good ADP and trade balance, why the USD only strengthened for a little spike and then weakened? Well, the US dollar did strengthen against commodity currencies. The data, which was very important yesterday, was partially ignored because of what's going on in markets. And we then had the Fed meeting minutes later in the day, which was seen as dovish because of the focus on inflation. So that hurt the US dollar a bit more. Okay, this answers the question. Question from Ryan, a technical question. I'm sorry for being such a beginner question. No worries, any question is legit. How do you know where to draw support and resistance lines, and how do you know which are strong and which are weak? For example, euro dollar and pound dollar. Well, of course, everybody draws support and resistance wherever he or she wants. What I see as strong support or strong resistance, I draw it basically on where the pair met resistance last time or support. So let's say here we have in euro dollar, we have, sorry, it's 107.20. Maybe it's not, no, let's update this line. We had the lows right here, 107.10, which was touched twice yesterday. Sorry, during the week. Okay, so if it was touched once, it's the low. It was already the low for in 2 months or so. Sorry, in over 1 month before the ECB. And then when it was touched again, it's sort of confirmation that this is a strong line of support. So it becomes a stronger line. It's a double bottom. The same goes with the top. This makes it stronger. A stronger line is also a round number because it has a psychological effect. Okay, so that's why 110, for example, on euro dollar, I see it as more important than 109.50, even though 109.50 also worked as resistance. Okay, of course, these are the basics. For when we reach uncharted territory, when we have a big breakout, many traders use Fibonacci lines. I don't use them, so I'm not going to try to confuse you with that. But in general, that's just on sort of very generally speaking, when we have, let's say, a pair trade in a range of 100 pips for quite some time and then make a breakout, doesn't matter if it's to the upside or to the downside. I personally look at previous levels, okay? So for instance, in euro dollar, I know that we've been here in the past. 1710 was some kind of support back here in November, so I look at this line. Others would look at, okay, we had a range, we had a fall. The range was 100 pips. Let's look at Fibonacci lines at the 38.2 and 61.8, if I'm not 61.8 lines, or the 50% line for the next support and resistance lines. But there are lots of better experts on that on the webinars and FX Street, so I suggest you do some follow up on webinars over there, read some material, because I don't want to give you incomplete answers. Okay. How do you see your dollar moving today and tomorrow towards the NFP? Well, that's a great question. That means I don't have a clear answer. I think the trend still remains to the downside in euro dollar. That's because there's still a bit more of monetary policy divergence to run. Okay. Now, because the ECB, there's still uncertainty about the ECB. The ECB is expected to do more, perhaps hint on January 21st and act in March, in their March meeting. And for the Fed, currently, they're still, in theory, on course to raise rates 4 times this year. Well, if we look here at the implied probability by bond markets, it's close to 50-50 with a small edge for a rate hike in March. I think the chances are much higher than that. But once there's less uncertainty, or once about the Fed and the ECB, we could, as I talked yesterday in the outlook, we could see a big rebound, a big change, of course, for euro dollar up to 120 maybe later this year. But for today and for the next few months, I think that the pressure is on euro dollar. Yes, we had some kind of recovery yesterday, but I think the trend remains to the downside. Non-farm payrolls could be good enough for another rate hike, perhaps not something too exciting, but good enough to say, yes, there's going to be a rate hike in March, don't worry. And if we have a rate hike in March after a pause, that means we could have also further hikes in June, September, and December. That means 4 hikes. So a bit more confidence about what the Fed says. So that could push the pair lower again. Okay. Hope this answers the question as well. I don't know if Jax is here in the chat or watching the show. Anyway, when his favorite question is which pairs to watch today, euro dollar is always exciting, and today we have the unemployment figures in Europe to have some impact. But I would say that the Canadian dollar is the star of the show today because of oil prices. All right. Just seems that the sky is the limit. We're about to reach new highs in dollar CAD. And because of the speech by Stephen Blows, the governor of the Bank of Canada. Okay. Oil prices, WTI crude oil. I think we have a clear trend here. 32.08 is the bottom. Anyway, we're under. If we look at the monthly chart, yeah, here we are, under the 2009 lows and back to levels last seen in 2004. And the talk about oil prices, talked about this in the outlook yesterday a bit in detail regarding the impact of oil prices on the US economy. And this is also an unknown for the Fed. The Fed says that the impact of oil prices is transitory. That means inflation is still solid, will still remain high, that it won't reach core inflation. What reaches core inflation is a stronger dollar, and that's also transitory. The Fed has this no worries approach at the moment. That's different from the ECB, which says that lower oil prices can reach core inflation and create this deflationary mindset, which means consumers don't buy too much because they expect prices to fall, and then we have less production, less employment, less money in pockets, and this kind of vicious cycle. Okay, but what we talked about yesterday is about impact of oil on the U.S. economy. So in theory, and I still believe this theory, is that it's supposed to be a net positive because Americans like their cars, they drive a lot, and there's hardly any taxation. So the price of gasoline at the pump is impacted a lot by global moves. Okay, so when it's a net, so the positive is that consumers have more money in their pockets. but we still haven't seen that. And regarding the negative side is that this fall in oil prices, the origin of this is the US shale industry, the production of oil in the United States, the growing production. We would expect that to fall. And also here, so far, production is quite stable, quite high. So around 9.1 million barrels per day. So far, it's things that were supposed to happen because of oil didn't happen. But I believe it'll happen in 2016. And especially if this bad mood about oil prices continues, if it's in the headlines all the time, it could trigger both things. Big cuts in the shale industry, less production, less employees, and that's of course negative for the US economy because some of these jobs are high-paying jobs, and also the mindset of consumers seeing lower gasoline prices for longer, headlines talking about lower prices, and they'll just consume more. How will this play out? I don't know. I still think it's a net positive, but yeah, we'll have to see more consumer spending. We'll have next week. We'll have retail numbers, retail sales numbers, and consumer confidence from the United States. Okay. More questions? This is the euro-dollar monthly. Of course, we're close. We're at levels last seen, of course, in December last year, which is not that far away. 104.60 is the low point on the downside for euro-dollar, the lowest in 12 years. A question: with only Eurozone unemployment rate and US jobless claims, what else will move euro-dollar today? This suit consolidating. No, I don't. Well, it could consolidate between these levels, but I believe that we do have factors to move euro-dollar. Mostly the atmosphere in markets, the price of oil. If things remain very gloomy, as they are now, it could support the euro. But if things improve, then of course we could see euro-dollar slide a bit lower. Okay. European stock market so far opened quite negatively, which is no surprise after the crash in Asia, especially in the halt of trade in China. Yeah. Another question from Ryan. In your opinion, who is the best person to take lessons from on FX Street to understand more about support and resistance? I'll have to ask my friends at FX Street for a good answer for that. Maybe Mauricio could help me out with that, or maybe someone else. I'll send out the question and get back to you. Pound dollar, what level can it go down to? Oh, pound dollar, the lowest level since. Let's take a look at the daily chart. Oh wow, that's quite a lot. That's since May. So I would say this is the next line of support. Yeah, thanks for asking, because I forgot to put the focus on the next support line, so it's not that far away. Okay. 145.70 more or less. And if we go below this line, we're already at the lowest level since 2010. Okay. And then we have some kind of support. Oh, that's a long way in the past. Well, it's already too much. Yeah, well, we're actually quite close to lowest levels in 5 years, right? Anyway, below these levels we have, let's add a few lines here. The line here in, sorry, that's 2009. Yeah, April 2009 at 136.47. if I'm not mistaken. Oh, sorry. Let's go back here. 142 is a round number and very far away. Perhaps we can add this low here of 143.50 more or less. And of course, the post-crisis low of 135 is sort of the line in the sand, even a bit below that. Okay. Oh, thanks, Mauricio. Yeah, you have a link here to the education section of FX Street. Okay, and you can also send us a mail. Thanks, Adinda. Hi, why don't you make a webinar on FX Street and trading strategy and thought process? I think all of us would appreciate, and we could also follow you better. Well, I focus on fundamental analysis and talk about and support and resistance lines. Technical analysis in general is just entry and exit points, and specifically I don't trade at the moment because I focus on publishing on Forex Crunch. So, but in general, that's the sort of, it's 80% fundamental, understanding what's going on in markets, seeing where the trend is, and then technical levels for entry and exit. Regarding technical analysis, trading strategies, as I said, there are really great speakers on FX Street and the webinars that can provide you with the full information. Okay. Yeah, okay, now we're seeing during the session some strengthening of the US dollar across the board. So at the moment, it's not risk on vs risk off, it's not euro yen against all the rest, but it's a stronger US dollar. No, sorry, the dollar yen is strengthening a bit more. Euro now it changed its mood and went again to the dark side, or if you wish, it lost the force and now it's falling again. So it's the yen, and then first in line the yen, second in line the US dollar, and then all the rest, with the euro also sliding against it. As I said, this monetary policy divergence is a force, and it currently doesn't exist that much with the yen, okay? Because Bank of Japan is stable, the ECB is expected to act, and in the United States we have further rate hikes coming. Okay, so I think it's time to do the wrap-up for today. This is the wrap-up for the live market open on Thursday, January 7th. Market turmoil controls markets. Chinese stock markets didn't last for 15 minutes until they shut down because of a crash of over 7%. Oil prices continue slumping, and all this has a huge impact on currency markets. Euro dollar is looking for a direction between expectations for ECB easing, that means weaker euro, and safe haven status, which is fragile for the pair. We've seen it now. We're seeing it 107.75. 108 is some kind of resistance. 107.10 is support. Very choppy there and looking for new direction. Pound dollar leans more towards commodity currencies, extending its falls now, about to reach the lowest levels since 2010, 145.80. It's currently at lows seen last year, but it could fall even below this level. UK Chancellor George Osborne talked about the cocktail of threats to the British economy. And this negative atmosphere is negative for the pound. The currency that clearly benefits from the turmoil is the Japanese yen. Dollar yen fell below 118, continues down. 115 is support, and also I think it's sort of the line in the sand for the Bank of Japan to begin talking nervously about an overvalued yen. Resistance at 118.20. Dollar CAD, the sky is the limit, reaching new highs as we speak. 141.50. 142 is some kind of resistance because it worked as such back in the summer of 2003. Yes, 2003, not 13. 12 and a half years ago. Of course, everything is related to oil prices. And today we have a speech by Stephen Pelosi, the governor of the Bank of Canada. Let's see if he hints about rate cut or not. With these kind of oil prices, it's of course bad for the Canadian economy. On the other hand, the weak Canadian dollar means that Canadian goods are attractive for US buyers. Okay. Aussie dollar lost the 70-65 line, after a battle. The 70 level is the next line of support, and then somewhere around 69. Of course, it's China, and China for the Australian dollar, but also building approvals in Australia missed, and this weighs on the Australian dollar. 70.65 is weak resistance, and then 71.50. Kiwi dollar getting also a bit carried away by this stock market rout, but on the other hand, we have an expectation for less production of milk by Fonterra, and less production means higher prices, which means some support for the Kiwi dollar. The bigger moves in currency markets are, of course, the yen. Wow, another fall in pound yen under 172, 171.60. Huge moves in the dragon, the JPY, whatever you want to call pound yen. It's crashing down 170. It lost another support line of 172. I would say the round number of 170 is further support. Similar moves are seen in CAD yen and ASEAN. These are, of course, the commodity currencies vs the safe haven one, the ultimate safe haven one, the yen, and it's clear the winner is clear. The yen is king now. Okay, so these are the moves. We had lots of figures yesterday that are certainly worth mentioning. Hints towards the non-farm payrolls. Better than expected ADP and FP, 257,000, but that was sort of blamed on the seasonals and not so exciting as the initial number seemed. Trade balance was a bit better, less important. US non-manufacturing PMI was a slight disappointment on the headline, but the employment component was quite solid and strong. Factory orders, no surprises. The Fed meeting minutes were perceived as dovish because there was focus on inflation, a significant concern according to the Fed members on inflation. On the other hand, they're not. They don't need to see inflation reaching 2% before hiking again, and that hasn't changed. So that weakened the dollar just a bit, but yeah, I would take. It's not a reflection of the talks, but an edited and revised and redacted document. Okay, in crude inventories, despite the headline about a fall in crude inventories, which is positive oil, we had a rise in distillates. That means oil that is gasoline ready to burn, and in general, we still have the same supply problems also from Iran, from Saudi Arabia, which are producing record levels of oil. So is Russia. And this is, of course, weighing on oil prices. Lower oil prices, of course, reflect lower demand, worsening global economy. Stock markets are falling. All in all, we have a gloomy mood in markets, and this sets the tone for everything. Okay, it's a bit overshadowing important figures, but tomorrow's non-farm payrolls remains the Caesar, if you wish, of indicators. Today we have a slightly lighter agenda, so watch more for stocks and oil than these figures. Eurozone unemployment rate is expected to remain steady. Maybe I'm hopeful that it'll drop a bit. As aforementioned, Bank of Canada Governor Stephen Pelosi talks. Let's see if he hints about rate cut. Jobless claims as usual. Last time they were disappointing, but maybe it's something seasonal. Let's see what's going on there. And for those trading the Aussie, we have an important figure: retail sales during the night. Okay, so that's it for today. If you have any quick question, anyway, we'll be here tomorrow with non-farm payrolls preview. And you're also, of course, welcome to ask questions about the 2016 outlook, which is also available in the recording. Thank you, Mauricio and Adinda, for the help on the technical analysis resources on FX Street. FX Street has an abundance of great materials, great webinars, great articles, and also my site Forex Crunch has articles. but you have interesting speakers if you prefer webinars on FX Street. So thanks everybody for coming. Wish everybody a safe and successful trading day. Let's take one last look at, yeah, euro dollar, some stability there, but the rest of the currencies are just digging the bottom against the dollar and the yen. Yen is king, and CAD and Aussie are weak. Last questions, Anna? Okay, thank you. Thank you everybody for coming. Have a safe and successful trading day, and see you all tomorrow. Thank you, and bye-bye.